This is a presentation I just gave in January 2026 at the ICAPE conference, which is a conference for pluralist economics. Those are economists that are thinking outside the box of the mainstream economics models. And the presentation is going to go like this. I'm going to kind of give you the premise of what it's about, the literature review, the work that I've done to develop an alternative visual diagram for the macroeconomy, responding to something called the circular flow diagram that is pervasive in macroeconomics and mainstream economics. And then in the fourth section, I'm going to show you that I think that this alternative model is actually more useful and accurate than the conceptual model that's used in mainstream economics today. And this is an ongoing project. I don't think that the alternative diagram that I developed is perfect or meets every need. So I'm interested in knowing, though, from you, like what works about it and what doesn't work about it, of course. So here's the premise. This is Kate Raworth. She's a pretty famous economist, particularly one critical of the mainstream economics. And she wrote in her book, Donut Economics, 7 Ways to Think Like a 21st Century Economist. She said, if we want to rewrite economics, we need to redraw its pictures too, because we stand little chance of telling a new story if we stick to the old illustrations. And then she went on to say, contrary to the textbook story and the circular flow diagram, banks do not merely lend out the money that has been deposited by their savers. They create money from nothing each time they issue loans. Now, there's 2 important points there. One is that she's putting emphasis on the importance of these visuals that are used in economics, and the second on this particular gap. And so I want to try and address the gap with the picture. I want to make sure that all of us are on the same page here about what we're talking about when we say bank money creation. Many people in the pluralist economics community are familiar with bank money creation. They might know it as something like the endogenous money theory of banking. But just in case you're not familiar with it, a good starting point is the Bank of England's publication, Money Creation in the Modern Economy, which was published in 2014 and has already been cited by over 2,000 academic works. And what this publication sets out to do is to set the record straight on where money comes from and how banks create money, and that it's different than how it's taught in the mainstream economics textbooks. So what this article says is that it explains the majority of money in the modern economy is created by commercial banks when making loans, and that money creation in practice differs from some popular misconceptions. Banks do not act simply as intermediaries, lending out depositors that savers place with them, nor do they multiply up central bank money to create new loans and deposits. And both of those ideas are ones that you can find in mainstream economics textbooks, the idea that banks are lending out depositor savings and that they're able to, in fact, lend out money and continue to tell their depositors that they have their money even though they've lent out their money, as long as they have central bank reserves. So they are multiplying up central bank money. Neither of those things are true, as the Bank of England is saying, because when a bank makes a loan to one of its customers, it simply credits the customer's account with a higher deposit balance. At that instant, new money is created. So it isn't that the bank is lending out a portion of deposits that it's received from its customers. It is entirely 100% of the money that's lending is coming from the fact that it can just open the accounting records of its customers and type in new money. The European Central Bank and many other central banks have published statements and publications saying the very same thing. This one's from the European Central Bank, and it says, if a commercial bank grants you a loan to buy a car, they create money in this way. And very importantly, when you repay the loan, the money created disappears. So I wanted to read you those quotes to help just shift from to a high level different picture of the relationship between money and the economy, where bank loans are entering new money is entering the economy every time a bank loan is made, and that the vast majority of our money supply was created that way, as the Bank of England said. And as the European Central Bank said, whenever a loan is repaid, that money goes out of existence. It disappears. It does not recirculate in the economy. So this is bank lending as opposed to lending by other entities like mutual funds or others that are lending out previously accumulated deposits placed with them by investors. What they're saying here is that banks are different. Bank loans are not coming from pre-existing deposits. They are every time creating new money that did not exist before. So this is the first kind of visual mental model shift that we need to make. Now, if any of that's unfamiliar to you or you're interested in learning more, if you go to moneyjustice.org insights/insights, I have a presentation there about where does bank money come from, and also references to some other great resources such as Positive Money's Banking 101 video series and the book Where Does Money Come From, published by the New Economics Foundation. Okay, so now that we're hopefully all on the same page about what we mean by bank money creation, let's go back to what Kate Raworth said. She said, contrary to the textbook diagram and the circular flow diagram, banks do not merely lend out money that has been deposited with their savers. They create money from nothing each time they issue loans, right? So now we're all on the same page. We understand what Kate is saying, and let's take a look at what she's talking about with this circular flow diagram. So if you look in mainstream economics textbooks, and this quote here is from the best-selling economics introductory textbook in the world for the last many decades, I think about 30 years. It explains the circular flow diagram this way. It says it's a visual model of the economy that shows how dollars flow through markets among households and firms. So this picture is literally about the money supply. It's about money and what is happening with money. And this is what the picture looks like. It's called the circular flow diagram because it's a circuit, and sometimes it's represented with rounded edges so that it is a circle. But what you can see here is that there's a green loop, which is money, and it literally says flow of dollars, and it's running from firms to markets for factors of production, which is basically where businesses are paying wages and so on, and to the households as income, and then the households spend the money in the market for goods and services, and the revenue comes back to the firms. So just to make that a little bit simpler, I have a very stylized, simple version of it here, and this is the canonical circular flow diagram. And what you can see is that when it comes to money and the flow of dollars, it is a closed loop. There is no representation of any money being added or removed from existence. And I hope by the end of this presentation you'll understand why that is so important. In fact, that is the purpose of this presentation, is to make the argument that it's important. And so here's what I'm arguing, is that the omission of bank money creation from the circular flow diagram is a highly consequential mistake because it contributes to incorrect theory, flawed mathematical models, unreliable forecasts, misguided policy recommendations, and poor economic governance. And this is true because bank money creation is a powerful force in the growth and structuring of the economy, as we'll see, and therefore achieving better economic understanding and governance requires the development of visualizations of the macroeconomy that incorporate bank money creation. And the visual developed here that I'm going to share is just a first step, but I would argue that it is already more accurate and more useful than the textbook diagram. So quickly, just to do a literature review, I've looked at hundreds of drawings of the circular flow diagram. They are ubiquitous, prominent, and core to mainstream economics. They are in the best-selling economics textbooks for the past 75 years, usually taught in the early chapters, and they're required as Unit 2 in the AP Macroeconomics curricula. And these pictures represent or reflect the thinking behind core aspects of our macroeconomic work and practice, from the measurement of gross domestic product and gross national income, to how we think about economic growth and what causes economic growth, and the Salo growth model, for example, how market clearing with DSGE models and the financial sector work. All of those things, when you look at them, they reflect this picture. And so if we change this picture, it calls those models into question, as we'll see. Now, I want to be clear that many times in the textbooks, the textbooks will present that super simple diagram that I was just showing you, and then they will make it more complex as the chapters go on. But what's important is that if you go all the way to their most complex versions, their most comprehensive versions of this picture of the macroeconomy, you will find that the money supply continues to be represented as a closed loop. I did not find in any one of the mainstream, certainly the best-selling economics textbooks, any version of the circular flow diagram, even one very complex like this one, that correctly showed the money supply being added and deleted through bank money creation. Importantly, I would argue that this omission of bank money creation is due to a conceptual error. So bank lending is believed to be a result of savings and is believed to be constrained in growth by central bank reserves. That is the belief of mainstream economics and is reflected in the models that both the visual and mathematical models that leave out bank money creation. And I would argue that these absences are reflected in the conceptual errors that are found in the fractional reserve and money multiplier stories of bank lending that are found in textbooks. So we need a new visual, but also we'll need to update these other stories and these other conceptual errors. And again, what I'm arguing here is that updating the visual will help with those other conceptual updates. And I should say that right here on this slide is the canonical money supply circular flow diagram as depicted by an economic historian who studied circular flow diagrams for a chapter in a book called Famous Figures and Diagrams in Economics. And you can see quite clearly here that there's a belief that the money being saved at banks is what's producing bank lending into firms. Okay, so I said that this is ubiquitous, and it is, but the omission is not entirely universal, because I did find two diagrams that include money creation by banks, and both were found in texts. Unfortunately, they're little known today. So one of the things you can do with this presentation is go look at these texts and help make them be more known. So the first one is from Kate Rayworth and the Donut Economics Action Lab. They put together a curricula with a group called Rethinking Economics International. And within the study materials, there's a slide that shows the circular flow diagram and shows banks creating money. And it says at the top, commercial banks do not turn savings into investments. They create money by issuing debt with interest. And I just want to note that this is an innovation even for Kate Rayworth of the last, maybe 8 years, because in her original textbook, the Donut Economics, there is no mention of, or this is not part of the visualization. What she's done here is she's added two arrows to show that that banks are creating money. They're pushing money out. Money is not coming in on the credit part of bank lending. And Andrew Hook is the other one. This is a paper not well known. I recommend taking a look at it though. And what you'll see is that Andrew is representing the commercial banking sector as having lines coming in and out of it that represent money creation and money destruction. So now let's look at the process or project of developing alternatives. So there have been, and I want to just acknowledge here that the circular flow diagram has been criticized by many economists for many reasons. And they, for example, feminist economists have criticized the circular flow diagram for omitting large numbers of economic activities that are unpaid or are cooperative labor, such as caregiving, raising children, many other things like that. And ecological economists have criticized it for omitting the fact that the economy exists within energy and resource flows that are constrained by what's available on our planet. And the post-Keynesian economists, for example, have criticized the emission of the government sector, and so on. And however, very few of these schools of thought criticize the circular flow diagram specifically for the absence of bank money creation. And as I mentioned, even those who do, I've only found 2 examples where an alternative visual has been proposed. I spent a lot of time looking at redrawings of the circular flow diagram produced by these different critics. There's an appendix that is many pages long with examples, and that's where I can see that that the critiques have generally not produced or have not produced additions of bank money creation to the circular flow diagrams in those schools. And I also derived from that literature review a set of principles for designing a new circular flow diagram, or rather I should say a new visualization of the macroeconomy that would incorporate and integrate these many critiques. And I want to give, again, Kate Rayworth a big shout out here, because she, in her redrawing of the economy here, has incorporated many of those principles already. You can see she has the feminist and care economists critique of the absence of collaborative non-monetary labor, reproductive labor, and so on. You have the ecological economist. She has a boundary around it all, showing that it's all happening within the planet, the biosphere's resources. And the post-Keynesian, she's got her government in there. But let's look at that money creation piece. Here she's got those 2 eras, showing that banks are pushing money out into the economy as creation. But what about money deletion? There isn't an obvious flow in which money is being deleted from the economy also. So again, just to update what I've said earlier, which is that we must get bank money creation into the picture of the visual of the macroeconomy, and we need to get money deletion by banks into the picture. And again, we need to do this because the emission of bank money deletion also contributes to incorrect theory and so on. This is an ongoing project. I have tried out a number of different things, all very different. The one that we're going to look at today is not on here. It's a new one. Emphasizing different things, trying to keep it super simple, like in the upper left, to trying to integrate the financial sector separate from the real economy, to trying to emphasize political choices and laws, and so. Just to say, this can get very complex, and let's just start out by asking, what's the simplest fix that can add inflows and outflows, and that is to, I would say, to add inflows and outflows without connecting the inflows and outflows, right? So both Andrew Hook and Kate Rayworth, and the canonical diagram that you saw earlier with the investment or savings equaling investment, that the economic historian had published. In all those cases, there's lines drawn from the economy into banks and banks back to the economy. And what's important about bank money creation, as the Bank of England explained, is that those lines are not connected, in the sense that you can have repayment flows that are not equal to the origination flows. And you can have origination flows that are not equal to the repayment flows. And really importantly, actually, there's not a direct relationship between either of those flows, in the sense that you could have origination with no repayment. You could have repayment with no origination. I mean, there's not a one-to-one relationship between the two at all, and they're not connected in the sense that repayments are not flowing through the bank and then back into the economy, which is an easy error to make when the two are connected. So this here solves that problem. You get the idea that bank borrowing is coming out of is being added to the economy. It's not coming from somewhere else, but bank money creation still appears to be very embedded inside of the economy. It's inside the economy. What do I mean by that? Let me show you. So let's go back to the super simple version. Ask, can we do better starting from the ground up? And what we can do is we can put a boundary around this monetary exchange and just call it the economy for right now. Of course, right now I'm not representing the non-monetary, care, reproductive, the ecological flows, and so on. We're just trying to keep it super simple. And so the economy here is in quotes. Now, what we do is we put bank lending outside of the economy, and we show that money coming from bank lending is flowing into the economy from outside of it. And the reason I think that that's important conceptually is that is what makes bank money truly distinct, is that it is money that has never circulated before inside of the economy. It is entirely new to the economy. No one in the economy has ever seen it before, when deposits are lent into existence by banks. And so conceptually, visually, I think this is important to put bank lending outside of the economy. And then the next thing is, well, how big do we draw these lines? Right here, the lines are pretty big. Does that overemphasize bank money creation relative to the circulation, which is your gross domestic product or your gross national income? And the answer is actually difficult to find, and the reason is that banks are not required to report what's called gross flow data for bank lending or money creation, and repayment, money deletion. They just report what's called the net stocks, which is at the end of a quarter, they'll say, this is how many loans we have. And then, economists will say, okay, well, how much did that number change from the last quarter? And they'll use that as the measurement of bank money creation or bank lending. And, if there's any kind of excuse for mainstream economists not understanding bank money creation and certainly not giving it any particular emphasis in their visuals and leaving it out of their mathematical models, it is the fact that the data is not available. In fact, for example, in Europe, the European Central Bank only started collecting this data in 2003. And most of the macroeconomic models that economists work with were invented, decades and decades earlier than that. So economists are primarily working with net stock data because it's what's readily available, but it is possible to find the origination data, and I'm grateful to the Macrofinance Lab at Beijing Normal University for helping me find this data. So here is some data that's drawing from the U.S. Federal Deposit Insurance Corporation, the U.S. Federal Reserve, and the European Central Bank. And what it shows you here is that for 3 countries, starting in 2016 and running to 2019, so this is 4 normal years, in quotes, but not pandemic years. This is normal-ish economic times, that the gross inflow of bank lending, money creation in the United States was $21.8 trillion. And the gross outflow was $21.4 trillion. Now, one of my colleagues at the Money Justice Collaborative, Boyoung, she taught me that it's really difficult to visualize or imagine $1 trillion. But one way to think about it is that if you spent $1 million per day for 2,500 years, you will not have spent $1 trillion, right? So in the United States, every year on average, for 4 years, the banking sector in the United States created 21 of those, and put them into circulation through lending. And when we talk about bank lending here, I just want to say I'm merging together bank loans, bank lines of credit like credit cards, and bank purchases of bonds where they're lending through buying bonds from corporations, and also buying equities in corporations. So all of those activities by banks create money. It's not just bank lending or loans, but we're going to use it as a shorthand. So an important thing to name here is that those numbers may look large to you or they may not. But let's say that they look large to you, or even if they don't, actually doesn't matter. they are under measurements. In the data sets that we're drawing from here, there's, for example, short-term bank lending missing from the U.S. data set. We don't know anything about the scale and the flows, the gross flows for under 3 months, and loans or credit that's granted for periods of shorter than 3 months. And obviously, that's a very large amount of bank lending. So this number, $21 trillion, could be significantly larger. In the European Central Bank data, we don't have any data on lending to the financial sector. Just to see, here's what the economists have typically been working with, which is the net stock data. And as you can see here, when you net the gross inflow and the gross outflow to get that stock, you see that these numbers are very, very small. And so why would you think that it's really important to incorporate it into your models if it's small? Right? And then just to put it in perspective of the economy as a whole, because that's the scale of the arrows that we were looking at before, the gross domestic product for the United States, for example, was $20.1 trillion on average per year in this 4-year period. So on average each year, the banking sector was creating and putting into circulation through lending more than the entire GDP, the entire economy's purchases of finished goods and services in that year. So 108% of GDP is the size of the bank money creation. Now, importantly, I chose these 3 countries because they represent different levels of bank utilization and cash utilization. I've presented this story of the role of bank money creation, and many times had people, particularly in the global south and countries where there's very high cash utilization, say to me, well, that may be true in the United States. It's very highly financialized economy, but that's definitely not true in Morocco. But actually, it is true. You can look at the data and see that even in countries like Romania that has very low bank utilization relative to other countries and very high cash utilization, the relationship between the flow of bank money creation and GDP is 238%. So nearly 2.5 times more money is being created by the banking sector and lent into circulation in Romania every year than the entire population is spending on finished goods and services. Now, how can that be for people who are living in villages and they're only using cash? The reason is because while they may not be borrowing from banks, they might not have access to bank credit, bank loans. There's somebody else in their economy who does, and it might be big import-export companies or something like that. So it's still there, the flow is still there, and it's surely affecting how their macroeconomy works, but it might be hidden in the day-to-day exchange of bills and coins. Okay, so let's come back to our picture. How do these lines look? Well, in the United States, $21.8 trillion in, GDP is $20.1 trillion. Maybe these lines are not so far off. And then let's get the principal repayments in there. So that's $20.1 trillion as well. So if these lines are not too far off here, you start to get a very different picture of the relationship between money and the economy, and certainly the relationship between what the business of banking is and the rest of the economy. Now, there's one more piece I want to add to the picture before we test the utility of it, and that is the relationship to government and to our governments. So this is Morgan Ricks, he was the senior policy advisor on financial reform for the U.S. Treasury following the 2008 crisis. And today he's a leading legal scholar on banking regulation. And he's proposed, by the way, that the banking sector should be regulated like a public utility. And you can see there maybe why. There's this whole system that the entire economy depends upon. And there are many other businesses like that in our country. For example, in the United States, we have electricity utilities that kind of the whole economy and people's lives depend on, and so we regulate them as though people's lives depend on it. We use our public institutions to make sure that they are operating reliably, safely, affordably, and so on. And but what's important here is he says, look, here's the deal. Banks are endowed with an extraordinary legal privilege. They are licensed to issue deposits, instruments, and the authority to issue them is the very legal privilege that a banking charter conveys. In other words, if we want to answer the question of where are banks getting the money that they're lending, we could say, well, they're getting it from nowhere, they're getting it from typing up their accounting records, or we could say that they're getting it from a legal privilege to create money that has been delegated to them or granted to them by national governments. And there's a great deal of research over the last 10 years by legal scholars saying, look, that is actually the way that we should understand this, is that our governments have given away or delegated away the privilege to create the money supply to banks. And think what you will about that. The bottom line is that who holds the money creation privilege is a creature of law, and that's very important to understand. So I think that adding that into this diagram of our macroeconomy is an important thing. Now, a lot of people say, well, wait, what about central banks? We've all heard that central banks are the ones creating our money supply. But in reality today, central banks and national governments are best understood as very large borrowers from banks that have special powers. Particularly, they can command that banks lend to them. But in most countries today, they pay banks interest on the money that banks create for them to spend, just as other bank borrowers pay banks interest on the money that banks create for them to spend when borrowing, right? So whether it's households or businesses or our government and our central bank, they are paying interest to banks to create money that they can then spend. And lots of people are resistant to this idea, so particularly in the economics profession, where they've been teaching for decades that central banks have direct control over the money supply. But there's one group that isn't confused about this at all, and that's the Banking Industry Lobby Association, the Bank Policy Institute, which is the lobby for the largest banks in the United States. And they have been actually very active on this topic recently because there have been proposals that central banks should actually force banks to lend to them or to create money for them at zero interest and fully under the control of government, I don't want to say whim, but government prerogative. And they have been publishing a number of papers saying, hold on, let's get this straight. Banks are the creators of the money supply, and the federal government is borrowing from us. And when you see the Federal Reserve, the central bank reserves that are very large numbers of central bank reserves, that's not money. That's the federal government's receipts for having borrowed from us. And that's why the central bank is paying us interest on our reserves, because those are the receipts for their borrowing from us that'll go out of existence when they've finished repaying us, right? So an important question is, does it have to be this way? The answer is no. Governments have created money in many different ways throughout time, and governments and central banks could create money directly or could require banks to create money for them at no cost via reserve requirements. So this is something that right now in the United States, for example, we have zero. We have a reserve requirement of zero, whereas people have pointed out that if we wanted to cancel effectively the entire debt of the central bank or the government, we could just raise the reserve requirement up to the amount of the debt, and banks would be obligated to lend that money into existence to pay off the debt, for example, and have debt-free government. This is something that's possible, and the banking lobby has been very active recently in saying, absolutely not, you cannot do that. But they acknowledge that it's possible in those same articles. So central banks do have the power to establish reserve requirements, so they can, emphasis in the original, make banks lend them money for free, right? So for folks who want to hold on to the idea that central banks are the creators of the money supply, I think that this is an accurate way to look at it. Central banks could be and can be the creators of the money supply, but right now they're choosing to act as just very large borrowers. that are creating money the same way you and I are creating money when we go to a bank and take out a loan. And thus the bank creates money for us. Okay, so let's test now the usefulness of this diagram. And we're going to do that by looking at the 2008 crisis. And what I'm going to argue is that I think already just with this conceptual picture, it leads to better diagnosis, better forecasting, better models, better theorizing, and better governance. So let's start with better diagnosis. This is Claudio Borio. He's the former head of the Monetary and Economics Department for the Bank for International Settlements. That's kind of like they sometimes called the central bank for central banks. And speaking about the 2008 crisis, he says, how can you make sense of the financial crisis looking only at the net flows? You can't. A sudden stop is in gross flows, not net flows. So what's he talking about? If you look at the 2008 crisis in the United States, banks stopped lending, and that was a major source of the crisis. And so you can see here that originations relative to repayments, went negative in 2008. And even you can actually see that it started in the fourth quarter of 2007. So with that insight, maybe we can get better forecasting. And because we can look at the particular factors that are modulating how quickly money is coming in or out of the economy, and ask, are there any early signals there? And in fact, there's research that shows that there is a very powerful early signal there. For example, the Draymond paper looked at 16 advanced and emerging market economies and showed that loan origination and repayment flows better predict economic growth, decline, and crisis than commonly used macroeconomic indicators. And Schuleric and Taylor found that a decrease in bank money creation predicts extra destructive financial recessions better than any other macroeconomic factor or combination of factors that they tested, including growth rates, interest rates, inflation rates, unemployment rates, saving rates, debt levels, investment rates, and more, right? So this is a pretty powerful forward signal. And really importantly, in Biggs here, they show that if you want to get your economy out of a financial recession, it is the return of new bank lending, not the scale of loan stocks, that's highly correlated with economic recovery and growth after sudden stop recessions. So this is both good for forecasting and also good for thinking about policy responses to financial recessions. And this is something that is recognized by some economists that focus particularly on money creation and money supply, like Steve Hanke. He said in 2008 the commercial banks were contributing about 90% of the money supply. As we went into 2008, they got squeezed and they started going negative. They started withdrawing credit lines and so forth, and the contribution of the commercial banks went negative. All right. Okay, so how about better mathematical models of the economy? One of the things that is true about the 2008 recession is that mainstream economists largely did not predict it. In fact, did not predict it. But there are economists that were non-mainstream economists that did predict it. And Dirk Bessemer here did an analysis of the economists that predicted the crisis and the economists that did not. And what he found is that there is an immediate link between accounting and the ability of some economists to predict the crisis. Previewing the results, accounting or flow of funds models of the economy turn out to be the shared mindset of a large subset of those analysts who worried about a credit cum debt crisis followed by a recession before the policy and academic establishment did. In other words, they understood that money is being created and removed from the accounting of the economy frequently and all the time by banks, and they understood that looking at the originations and repayments was important. And then he turns and he looks at the mainstream economic models that didn't predict the crisis, and he says, look, if you look at these models, they completely abstract from financial flows. The only financial flow variable is the interest rate. So there's literally not a variable. There's not a number being put into the mathematical, the workhorse mathematical models of the economy that mainstream economists are using for bank money creation or deletion. Those numbers are simply not being put in because there's not even a variable for them. So second to last, I think that visual model already also leads to better theorizing. Particularly, for example, if you think about who has agency, right, in this picture. Is it all demand driven? So we have one heterodox school of economics thought that's non-mainstream, called post-Keynesians. And post-Keynesians are, I think on top of this in that they understand bank money creation very well. They're the users of the flow of funds models. They are largely the ones who predicted the 2008 crisis. But interestingly, if you look at their models and papers, they will often describe the quantity of bank lending as being entirely determined by the desire of businesses and households to borrow. That is the demand for loans. And I think that that's missing a very important dynamic because in the 2008 crisis, in fact, what we see is that banks stopped lending before borrower demand declined. Banks got scared. They decided that they weren't going to lend as much anymore. They were just looking out for themselves as maybe they needed to do. But the result was, in this study, for example, of the Spanish economy, was that borrowers that had been able to get credit, loans, no problem before, they had great credit, good businesses, suddenly were having to apply to 6 banks before they could get a loan or not be able to get a loan at all, whereas before they had no trouble. And they still wanted to borrow. The demand was still there. And also, banks stopped rolling over loans and began demanding more collateral from large borrowers or even just any types of borrowers that still wanted to be borrowing. They still wanted to be able to, have their credit card roll over, more for the corporate sector than personal accounts. But it was banks who decided, we're not going to roll that over anymore. You have to pay us back right now. So if we have a better theorizing of who's agent in the macroeconomy when it comes to the money flow, we can do better governance, better policies, and so on. And so in terms of governance, what can we do differently? And one of the things that I think putting the legal privilege to create money at the top here does is it visualizes, it communicates that there is a role for governance here. It's not like the money supply is just this natural thing that occurred out of barter and coins and feathers and shell beads and so on. It's actually something that at least today is a legally constructed government operated system, and that we as a public, by having delegated this privilege to for-profit private banks for the most part, particularly in the United States and in Europe, we as a public are subsidizing the banks with this particular choice of how to operate our money supply. And as Salia Armova says here, she's a banking law scholar and at Cornell University Law School and a nominee for the U.S. Comptroller of the Currency in 2020. She says, we as a public are subsidizing banks. We are subsidizing in a very important sense their ability to make profits. So we have the right to press them all the time with respect to the decisions that they make. This is kind of that idea of a public utility, right? Our electric utilities are using right-of-ways in our communities to run their electricity lines, and they are operating a system that that is very profitable, providing a monopoly service that our governments are saying you can't. We're only going to have one electric utility here. We're not going to have two. So it's the government is enabling that monopoly subsidy, and so in those other industries, we have a pretty clear idea that the government does have a role to regulate those companies. And what we're saying here is the banking sector has a monopoly. The banking sector as a whole has a monopoly on the legal privilege to create money. And so once you see it that way and you understand it as a government project, then things like regulating lending flows with credit quotas and credit ceilings and interest rate ceilings and credit market segmentation. These are all things that have been done in the past. I would argue very effectively. I have other presentations on that. If what you care about is strong economic growth and inequality and many things that have to do with creating not only a strong economy but a strong society, these things have been very effective. But today, they are largely disparaged by mainstream economics, and they are, considered to be intrusions into a money system that's supposedly just evolved out of barter and shell beads and coins, um, outside of a role for government. And so now government is meddling, with the monetary supply and the monetary system. Whereas what you can see here in this picture is that actually the entire thing is government created in the first place. So just to close out here and say again on this governance piece, that picture shows that there's a lot of design choice in governance that is shaping the system the way it is. And if we don't like the way that it's working today, then we can have a conversation about whether or not it should be shaped differently. And what I think also this picture does is show that there's a highly, highly concentrated point of intervention here, where a small change in the legal privileges could shift the entire economy. So let's just say, for example, that instead of delegating the privilege to create money to for-profit commercial banks, the government delegated to local, publicly operated, not-for-profit banks. Right? This has actually been done, and I would argue that it's quite effective. In Germany, about 30% of the banking in the country is done by locally operated, publicly owned, not-for-profit banks. Right? It produces very different types of investment and outcome in their economies than private for-profit banks provide. Right? So this is just a small shift that could be made. Also, the government could, through the central bank, and through regulations, actually create debt-free money and spend it into circulation instead of taxes or instead of borrowing and having a massive national debt. So these are choices that are possible, and they're actually also things that don't necessarily require huge changes in the law. So Bob Hockett here, he's a Cornell law professor who has taught a lot and written policies for congressmen. And he says, if we target the right parts of the right regulations or statutes with very small tweaks, we can very quickly shift from speculative finance to productive finance, a full public banking platform, or both. And again, I think this picture shows that this legal privilege is right up there at the top of the entire flow, and you can imagine that a small tweak could produce a very big effect. So that's my presentation. I welcome people connecting with me through my university email address. I'm also a research lead for the Money Justice Collaborative, which is a nonprofit project interested in how this intersects with social justice. And I also have a blog, of course, on LinkedIn and so on. So please do share with me your thoughts on these diagrams and what works, what doesn't, and any other thoughts you may have. Thank you.